Hi, this is Roger Conrad. I'm editor of Canadian Edge. What I want to talk about today is the broad market and where our companies stand in it. Obviously, we've had some pretty intense volatility in global markets the past few weeks. I've tried to keep you abreast of the situation, where I stand on it, in a series of flash alerts, and hopefully everyone's been able to read and digest those. At the same time, all this volatility has been going on. We've had, I would say, almost an unprecedented number of companies announcing earnings all at the same time in our portfolio. And of course, earnings numbers are a very big part of what we do. We're very concerned with dividends, we're concerned with financial health, and we're concerned with the ability of companies to increase dividends over time. I think one of the main attractions of our Canadian Edge companies is that we have been through this period of slow dividend growth or no dividend growth, particularly as many of our companies converted from trust to corporations. Now they've converted, now we're starting to see growth pick up, and we're seeing a return to dividend growth. So this is a very important theme. There's nothing like dividend growth to protect you against the two things that really affect income investors over time, one being inflation risk, the other being credit risk. Dividend growth is the best insurance against all of that. One thing I was very concerned about coming into second quarter earnings season is whether or not the slowdown that we have seen in several sectors in North America, apparently in the United States as well, would that translate into weakened earnings or perhaps weaker balance sheets and financial health for our companies? And while there was an exception, Yellow Media, which we have sold now, but while there was that exception, nearly 3 dozen companies that we have, the others in the portfolio, did report very solid earnings. And what I mean by that, they covered their distributions solidly. They maintained their management guidance, in other words, in terms of profitability. They kept their projects for growth on track. And there were many also encouraging statements and actually some regarding dividend growth and also some dividend growth. So, as you peruse those flash alerts and look at the companies covered there, and in the last one, actually, I tell you where to go to look at all the earnings that we've had of companies coming in. As you peruse those, you'll see that as a common thread throughout. Strong earnings, solid cash flows, good dividend coverage. In many cases, also very strong balance sheet action, whereas companies have basically eliminated the refinancing risk for the rest of 2011, and many all the way into 2012 and even beyond. So it's a conservative group, and they're also growing. Very, very encouraging. Now, that's really the most important thing in the long term. How are these companies stacking up as businesses? Are they maintaining their strength? Are they able to continue to pay dividends and also perhaps ratchet up dividend growth going forward? These are the key questions that you have to ask all the time. Those are really the factors that are going to determine what sort of returns we get long term, whether we build wealth, whether we hold, or whether we just hold our own or even lose money. Some companies are going to blow up along the way when there's a bad economic environment. It's pretty much all the blemishes come to light. But again, our companies have hung in there. Student transportation, one that we've just added, now also seems to be coming along pretty well. And you can read about that in the high yields of the month. So that's really the positive case. Now, how does that fit in with what we've seen in the market? Obviously, a lot of these companies took hits in the past couple of weeks. We've seen, as the market stabilized, we've seen those stocks stabilize. So very similar market action to what we've seen coming out of every downturn, including that of 2008. I don't think this is going to approach what happened in 2008. I think the global financial system is in better shape. Obviously, in 2008, there was a lot of uncertainty. There were a lot of, really no one really knew where all the bodies were buried regarding the mortgage-backed securities. We're not in that position today, and in fact, if you look at the downgrade of S&P made of U.S. Government bonds from AAA to AA+, a lot of hand-wringing went on in Washington. It was the first time in 70 years the U.S. government isn't rated AAA by S&P. But what happened to that asset, to the Treasuries? An unprecedented rally. In fact, yields on the 10-year went down to about 10%, to about 2%, rather, the lowest level ever, and many shorter-term securities those interest rates on those went pretty close to zero. So at the same time you have this credit rating downgrade, you have the asset that supposedly was downgraded rallying to new highs. I think that shows pretty much where the credit agencies stand in terms of credibility in the marketplace, given their many miscues over the past 10 years at least. But more importantly, I think it shows that we're still in the same kind of market we've been in since late 2008, and that is on days when people are worried about, it's all about the economy. On days the people are worried about the economy, they sell everything off, including Canadian securities. On days when they're less worried about the economy, they buy, including our Canadian securities. I think this time around things were a little less severe than they were the last time around, mainly because the Canadian dollar is now perceived as something more of a safe haven currency than it was back in 2008, when it was pretty much considered to be a petro currency. So I think that's a big positive. But going forward, we're still in the same kind of slow, jagged growth environment in North America in particular, but globally also. And this affects the environment. It's the same market we've been in since 2008. And as long as the economy is growing slowly and jaggedly, we're going to see the potential for these kinds of sell-offs, again, when people start worrying about the economy. So is this important? Is this something we should worry about? I think one thing that we've seen when you do have these sell-offs is you have incredible buying opportunities. You have companies that literally announce strong earnings, perhaps even dividend growth, the same day they get taken out and shot by the market on these macro worries. So that's the time when you buy. During the flash alerts that I've sent out the past week or so, I've identified a number of companies that I think are in good buying range. I think they're still there. You want to check the portfolio tables and make sure you're not paying more than my buy targets for the companies. But if you do that, I think there's an incredible number of opportunities out there to take advantage of. And of course, we'll be having more updates, more as far as the market goes. We have the September issue coming up at the end of this month. That'll be maybe recapping some of the developments. But this is a good time, if you're light on any of these, to pick up some shares. So that's all I have to say today. I hope you'll take a look again at the flash alerts at the August issue. A lot of information there, a lot of good buys, and this is one of those opportunities, as was the case in 2010, to take advantage of the markets still being quite skittish and still responding very much to this economic scenario where, again, good news, people buy everything, all kinds of equities, sell things like treasury bonds, and then when the economy looks weakening, they buy treasury bonds, sell everything else. Take advantage of it. Thanks for tuning in.